Hello, folks. I'm sure, unless you've been living under a rock, we've all heard about this. Adani versus Hindenburg. And so, what has happened? What is the issue? And what are the facts underlying this? We're going to look at that. Fine. So, there's quite a few statements traded by both sides. There's a lot of passion about both sides of the debate. And so, I want to look at what are the concerns that we have, and what are the charges that have been filed. What is the takeaway for us from here on in? So, what are the concerns that the Adani firm can talk about? Any group of concerns, the level of their debt, net debt, debt servicing, what is the market cap? So these are three things that are things that we need to look at and say, hey, is there something to worry about here? Right? So net debt level is rather high. It's astronomically high. Adani group of companies, to start with, are in infrastructure, and lots of every segment of infrastructure building, they are there. Infrastructure building is a heavy investment intensive industry, heavy capex intensive industry, which is capex is capital expenditure, and it's a long gestation period industry and low margin industry. Thus, you put a lot of money upfront and let the build-out process happen for a while, and then you can make money off it for a long time at low margins. Low margins initially, and over time it keeps getting better and better. Because the long gestation but rather stable industry, after you've got the deal, typically a lot of debt is involved. You cannot say, I will have my money, build an infrastructure project, work with operating margins of 5% and see if we can make return on equity. And so the debt levels of the entire group of companies is high, has been high. Their growth has been primarily funded with debt. Lots of debt across the board. And so their net debt to the book ratio is high. Debt servicing concerns are there. Debt to market capitalization has been rather favorable because their market capitalization has just flown. It's just run away, which just brings us back to this place. The group company's market capitalization has flown and it's just taken off. There's been very few large companies with this much growth in market capitalization in the history anywhere. And so that they have a lot of debt is not a surprise. Infrastructure companies tend to have a lot of debt. Nothing to worry about that. That their operating margins are low is not a concern. The infrastructure companies do not have high margins. This is not tech. It's not an issue. The debt servicing is the idea of, do they make enough money to keep paying interest on these debts? And so there's a little bit of a question on that. Their market capitalization levels are astronomically high, but you cannot put any relevant valuation metric that you can see, price to earnings or EBITDA or how many times book, where this is justifiable or easily comparably justifiable as far as their numbers are concerned. Their cumulative market cap is close to $220 billion. Their revenue multiple or profit multiple is not there, it's not relevant. We cannot even compare on those bases and say this is slightly high PE. PE metrics cannot be brought into the picture. They're astronomically high. So there are concerns over each of these. Net debt is a concern because it is high. They funded their growth with debt for several years in a row now, and they have had liberal doses of debt being added to the balance sheet, and they're doing lots of good stuff, but it exists. Right? Debt servicing is a concern because their interest rates on that debt, if it goes up slightly, then their operating margin will not cover it. It is rather close. And so if either their margin crashes a little bit or the debt interest goes up, then we have an issue. The market cap levels have flown, they've just taken off, suggesting that all their investment bets in infrastructure are going to be spectacularly correct. And so getting a lot of my data and information analysis from Professor Ashwath Damodaran, who's a fantastic teacher of valuation. Several times you may not agree with his theses and his calls, and whether it's high or low or whatever, but the way he explains and outlines how he values assets is brilliant. So I would strongly urge you to go through that link, which again is given in the description of this video. Go through that link. It's good, rather good. He doesn't talk about, hey, buy this stock, sell this stock, this is correct, this is wrong. None of that. Again, I'm not going to jump in and say buy the stock, sell the stock. I'm not going to say there's a foreign conspiracy. I'm not going to say dying of Indian infrastructure. None of that. And so concerns on this debt level is a concern. The fact that the market cap is out of whack and flying and extraordinarily high is a fact that you have to keep in mind. And debt servicing, it does not so much buffer that we don't need to simply worry about the debt. Right? Now, what are these guys saying? What are the charges? And I put up different letter, I put like ton of charges, reams and reams, pages and pages of charges. I put them into kind of 3 buckets. They're saying the Adani Group has tons of shell companies. Right? To first up, there's no law against having organizations across the world. And so we don't understand the legal mechanisms, challenges they have for which they have put this. There's lots of labyrinthian regulations that are there. Just having shell companies and saying, look, have you a lot of shell companies is not any establishment of guilt. Right? They've alleged stock price manipulation. They basically said there are companies that they've alleged that lots of related party transactions have not been highlighted. They're saying you have all these shell companies to create an impression of stock trading when it's actually not happening. Saying that lots of stock trading in this asset has happened within its own listed or not listed within these related parties. That's an issue. There's almost a lot of circumstantial data, but no one specific strand to jump in, which is what has made some of the people really irked and said, look, it's not establishing guilt in any form. Right? So the one thing that they've said is the holding for any listed company in India has to be less than 75%. And Adani Group companies are very close to this. Why have their allegations carried this much weightage? One, as we said, the market cap is out of whack. Several companies, the group holdings are very close to 75, 72, 73, 74. They are thereabouts, very close. Fine. So there are a bunch of foreign institutional investors that are there. Okay? Bunch of retail investors there. There are no large Indian mutual fund that has any exposure. The remaining 25%, even the FII exposure is because they've crossed certain limits and they're part of some indices. Therefore, the FIIs have to buy them. They have to be exposed to the index, so they're buying them. So, of the Indian mutual funds, they form a clear benchmark of, hey, we like this company, we understand this, we are having exposure to this stock. This is a stock that has run and run and run. The Indian mutual fund exposure to this is minimal. And so there is a certain part of what we don't understand at all about the valuation of this group of companies and all the dynamics surrounding that. In that setting, in that context, when this has come out, even though there's no establishment of, okay, this much money transacted from this person to that person, manipulating this stock to go to this price, which they placed as collateral to take this loan, and they've been doing this for years, that's not there. But the mere hint of saying, look, lots of shell companies, transactions not being explained, stock price manipulation happening because of that, and if you include some of those shell companies as their own assets and you highlight that the related party transactions are there, then the holding will cross 75%, which means the company technically should not be listed. All of that. That's the crux of what they're trying to say. Right? Why has this found such good reception? A small organization sitting somewhere saying all these things are happening is because of the things that we discussed. There's no logical explanation for an astronomically high market cap. This is a company in a long gestation period, low margin industry, which is not having any extraordinary profitability, is having extraordinary debt and a broad concern about how that debt is going to be serviced. And that is there, that is sitting there. Right? So then why should a company that has such astronomically high debt and a worry about, okay, how may will they be able to service it through ups and downs, have such astronomical market cap levels? Because of this whole enigma, that is the key reason why Indian mutual funds don't have exposure. Right? And therefore, it's not like a giant rock has been thrown, it's only a small domino has been hit. But it's already slightly worried market decided to say, look, I'm not touching it, and therefore the price catch step by step. Now, the most important thing for the rest of us is, look, what does it mean for India? And so the two people who have been mentioned over and over again are SBI and LIC. LIC owns a significant proportion of Adani stock, Adani holding, and SBI has lent to Adani. And so far Adani has not said, look, we are folding and we're not paying interest. No, we're not even close. SBI does not consider this a significantly high bad loan risk right now. And that could change, but right now that's not the case. LIC has stock holding. LIC's holding in Adani is not so high that Adani has to worry. Definitely not so high that LIC has to worry. So the exposure for both of them as a percentage of their book, the numbers are very large in terms of our basis. They're not significant on the basis of the SBI number. So all SBI will have, all these large banks will have NPA, non-profitable assets, of 2-3% of their book. Their entire Adani holding is much lesser than the maximum or the average value they'll put as NPA. Likewise for LIC's total portfolio exposure, their size of their book, less than 1%, 0.5% is what they have with Adani. And LIC is sitting on a 50% return on Adani holdings after the stock took a beating. So if they sell all Adani stock today, which I'm not saying they should, which they won't, they'll be recognizing a profit on their Adani holding, not a loss. So these two, they've come to clarify this. No, they should not even have needed to, but there's nothing to worry for a broader thing. This is the point. This is who we are. This is something that Mr. Ashwath Damodaran, who's like a doyen of explaining valuation. I'm not even saying he's a brilliant stock picker or something, but he explains valuation really well. There's a wonderful piece on this on the internet, and you can find the description. You can find the link in the description, where he says there is an element of this is who we are, about our banking system, or about our mechanism, where we say, look, Indian banks are rather comfortable lending to family-owned enterprises. There is a thought process that says that, look, these are conglomerates. We don't understand all the mechanisms of how all the different parts work, but the sum total of it, one will bail the other out. We can lend to them. One is we have to lend to them, because if you have a policy saying mechanisms like this, I won't lend to, you can't lend to 75% of Indian business houses. So dealing with family enterprises is something that Indian banks have to live with. That is an issue. Second thing, Indian people, us, we are very comfortable with opaque structures. There is an element of, hey, we can live with this. We don't know who owns this. We don't know what is their clear operating profit. We don't know the ownership structure of 7 different companies of a family group. We don't know. We don't know who's exactly owning this. This company owns 14% of this, 18% of that, 25% of that. We don't demand transparency. We don't demand clean ownership structures. We do not demand clearly identifiable structures which are different across conglomerates. According to us, them all being linked in the hip is a good thing. And then we punt based on, hey, this is what we are. And he also says, the professor says very clearly that India is a momentum market when it comes to stocks. Things go up, we go with it. When things crash, we crash with it. So we don't pause and say there is a valuation mechanism for this. There is an element of this is who we are, which has brought us to this point, where there is several rounds of bank lending that happens to opaque family conglomerates, and the public have come to uncut stocks of opaque opaque family conglomerate that we have come to accept. The banks have had to deal with that has led to this point. Probably what I would love to see is for this to not happen, for the banks to say, hey, if your structures are so opaque, I'm not lending to you. If I don't know who owns this company, I can't lend to you. For public to say, if this company, this family group has 17 entities, you're listing the 18th one, clearly say who owns what in the 18th one, clearly highlight what is bought by whom, which company you're selling to, who you're buying from, and only then we'll give you some multiple of stock. Have a discount to stock prices of companies that are non-transparent, that are opaque, that are vague, that have too many transactions within their family group. If the Indian market moves to that place, if our Indian banking moves to that place, that will be brilliant. I hope that happens. One chance to probably clean up the way we think about conglomerate companies, opaque listings, so many entities all over the place. If that indeed happens, that would be really nice. Is there a concern with their market capitalization? Yes. Is there a concern with the how much the stock can take a hit? Perhaps yes. But if you look at this, one of the things that we're saying is the cost for concern, 75% owned by them. And if the stock price crashes, who are the losers in that transaction? Them. They might have placed the stock as collateral and taken some borrowing. The borrowing seems to be covered. The banks don't seem to be unduly worried. They anyway historically had lots of debt. Operationally, they seem to be running all right. Their valuation could be out of whack, but the exposure to SBI, LIC, or to the small investor, they're not that high. To some extent, the stock price crashes and burns. The stock price could crash and burn, and the companies could be functional. The companies could be functional, and debt could be serviced, and there could be no impact on SBI. The stock price could take a tumble, and LIC could still not even notice it. A bunch of retail investors who are riding all kinds of momentum will get beaten up. not a minute too soon. And retail investors have to be careful about what they invest in. So it'll be good in terms of those lessons learned. But I don't think it's a flashpoint crisis for India, and we need to feel really worried about this one thing creating a domino effect for 100 things. Sometimes news points are trigger points for the market, but the facts are not like that. And nor is it some international conspiracy, all kinds of things. So we all rallied to a point where they're looking to take sides. There's an element of that has definitely happened in this. Some people are dancing on the aisles because the stock got beaten up. Some people are super peeved that somebody else returned this report. All those things, I think, is just the fact. It's a feature of the moment we live in, rather than anything related to the facts. And so, best wishes, guys. You focus on what is most important for us, which is preparing to crack this exam.